This lecture gives a perspective if we can beat the market using ETFs, exchange traded funds. The intrinsic value of ETFs depends on the fundamental value of the underlying securities. It is quite possible that the market sentiment may create a wedge between the markets and the intrinsic value of the ETFs. Valuing ETFs can be a much more complex task than valuing individual securities. To arrive at intrinsic value, you need to discount the current and expected cash flows from the underlying securities. For example, if the ETF consists of 20 stocks, then we need to estimate the intrinsic value each of these stocks. The fundamental or intrinsic value of the ETF will be more or less weighted average of these underlying stocks. Once we have evaluated the fair market value of our ETF, we can compare it with the prevailing market price. If the market price is above the intrinsic value, the ETF is overvalued and should be sold. Conversely, if the market price is below the intrinsic value, the ETF is undervalued and should be bought. Other factors impacting the value of ETFs are: A. The quality of earnings and management of the underlying funds. Economic moats such as cost or product differentiation give competitive advantage to these companies. For example, a deep rooted network, as in case of eBay or Amazon, forms as a moat. And still, in other cases like Gillette or Coca Cola, the old established brand does the job. In essence, it is the moat that keeps the competitors at bay. B. Business risk. Business risk is the risk of potential failure of a company. It is business risk that creates uncertainty in true estimation of the cash flows of a company. Business risk could be driven by either internal dynamics of the company or could be a function of external events that can affect the smooth cash flows of the company. C. Diversification is another strategy to contain volatility. For example, given the boom bust nature of the real estate businesses, it might be risky to put your eggs in a single real estate company. Volatility would decline if you were to invest in a bunch of real estate companies. Proper diversification would justify shrinkage of margin of safety.